The SEC, or the Securities and Exchange Commission, is the federal agency that regulates the securities markets in the United States. One of its roles is to oversee how public companies buy back their own shares from the market, a practice known as share repurchases or buybacks. Share repurchases can have various effects on a company's financial performance and market value. For example, they can reduce the number of shares outstanding, increase earnings per share, boost share price, signal confidence in the company's prospects, return excess cash to shareholders, or offset dilution from employee stock options. However, share repurchases can also raise some concerns for investors and regulators. For instance, they can reduce the amount of cash available for investment, growth, or debt repayment. They can also create potential conflicts of interest between management and shareholders, especially if management compensation is tied to share price or earnings per share. Moreover, they can create opportunities for market manipulation or insider trading, especially if management has material non-public information about the company's performance or prospects. To address these concerns, the SEC has adopted rules that govern how and when public companies can repurchase their own shares. These rules are intended to protect investors from unfair or deceptive practices and to promote transparency and integrity in the securities markets. One of these rules is Rule 10b-18, which provides a safe harbor for companies that repurchase their shares in compliance with certain conditions. These conditions include limits on the timing, price, volume, and manner of repurchases. For example, a company cannot repurchase its shares at the beginning or end of the trading day, when the market is most volatile. It also cannot repurchase its shares at a price higher than the highest independent bid or the last independent transaction price. It also cannot repurchase more than 25% of its average daily trading volume in a single day. And it cannot use more than one broker or dealer to execute its repurchases on a single day. Rule 10b-18 does not require companies to disclose their repurchase activity or plans to the public. However, it does require them to keep records of their repurchases and report them to the SEC upon request. Another rule that affects share repurchases is Rule 10b-5-1, which provides an affirmative defense for insiders who trade in their company's securities while in possession of material non-public information. This rule allows insiders to adopt written trading plans that specify the amount, price, and date of future trades in advance, and to execute those trades according to the plan regardless of any subsequent changes in information. The rule also requires that the trading plans be entered into in good faith and not as part of a scheme to evade insider trading laws. Rule 10b-5-1 does not prohibit insiders from repurchasing their company's shares under a trading plan. However, it does impose some restrictions on how such plans can be adopted and terminated. For example, an insider cannot adopt a trading plan during a blackout period when other employees are prohibited from trading. An insider also cannot adopt multiple overlapping trading plans or modify or cancel an existing plan while in possession of material non-public information. Rule 10b-5-1 does not require insiders to disclose their trading plans or activity to the public. However, it does require them to report their transactions to the SEC within 2 business days. In addition to these rules, the SEC has recently adopted new disclosure requirements for share repurchases that will take effect in 2024. These requirements are designed to provide investors with more information about the purposes and effects of share buybacks. The new requirements will require public companies to disclose the following information in their periodic reports: a table with daily data on their share repurchase activity for each quarter or semi-annual period, including the number of shares repurchased, the average price paid per share, the number of shares purchased under a publicly announced plan, and the number of shares purchased under a Rule 10b-5-1 plan. A narrative description of their objectives or rationales for their share repurchases and the process or criteria used to determine the amount of repurchases. A description of any policies and procedures relating to purchases and sales of their securities by their officers and directors during a repurchase program. A statement indicating whether any officer or director has adopted or terminated a Rule 10b-5-1 plan during a repurchase program. These new disclosure requirements are intended to help investors better assess how public companies use share buybacks as a capital allocation tool and how they manage potential conflicts of interest or market abuse risks associated with such transactions. In this section, we will explore how share buybacks can affect the market value, earnings per share, and executive compensation of public companies. Share buybacks are when a company uses its cash to purchase its own shares from the market, reducing the number of shares outstanding. Share buybacks can have various effects on a company's financial performance and valuation, as well as on the incentives and rewards of its executives. One of the main effects of share buybacks is that they increase the earnings per share (EPS) of the company. EPS is calculated by dividing the net income by the number of shares outstanding. By buying back shares, a company reduces the denominator of this ratio, resulting in a higher EPS. EPS is a key metric that investors use to value a company and its growth prospects. A higher EPS can boost the market value of the company and its share price, as well as signal confidence and undervaluation to the market. However, not all EPS growth is created equal. A higher EPS does not necessarily mean that the company is generating more profits or creating more value for shareholders. It could simply mean that the company is distributing more cash to shareholders instead of investing it in productive assets or projects that could generate higher returns in the future. In other words, share buybacks can artificially inflate the EPS without improving the underlying performance or profitability of the company. This leads us to another effect of share buybacks: they can affect executive compensation. Many executives receive performance-based pay that is tied to their ability to meet or exceed certain targets, such as EPS, revenue growth, or return on equity. By conducting share buybacks, executives can manipulate these metrics and increase their own pay, even if they are not creating any real value for shareholders or the company. For example, suppose an executive has a bonus that depends on achieving a certain EPS target. By buying back shares, the executive can reduce the number of shares outstanding and increase the EPS, thereby triggering the bonus payout. Alternatively, suppose an executive has stock options or restricted stock units that vest based on achieving a certain share price target. By buying back shares, the executive can increase the demand and reduce the supply for the company's stock, thereby driving up the share price and making the options or units more valuable. These examples illustrate how share buybacks can create a misalignment between executive compensation and shareholder value. Executives may have an incentive to conduct share buybacks that are value-destroying or value-neutral for shareholders, but value-enhancing for themselves. This can lead to suboptimal capital allocation decisions and short-termism that harm the long-term interests of the company and its stakeholders. To summarize, share buybacks can have various effects on the market value, earnings per share, and executive compensation of public companies. While share buybacks can be beneficial for shareholders if they are done at the right time and for the right reasons, they can also be detrimental if they are done for the wrong reasons or at the expense of long-term value creation. Share buybacks are a way for companies to use their excess cash to repurchase their own shares from the market, reducing the number of outstanding shares and increasing the earnings per share and the ownership stake of the remaining shareholders. Share buybacks have become more common in recent years, especially in the U.S., where companies have spent trillions of dollars on buying back their own stock. But what are the potential risks and benefits of share buybacks for investors, employees, and the economy? One of the main benefits of share buybacks for investors is that they can increase the value of their shares by boosting the demand and reducing the supply of the stock. Share buybacks can also signal that the company believes its stock is undervalued and that it has confidence in its future prospects. Moreover, share buybacks can improve some financial ratios, such as return on equity and earnings per share, by reducing the equity base and increasing the net income. Share buybacks can also help companies avoid paying taxes on dividends, which are taxed at a higher rate than capital gains. However, share buybacks also have some drawbacks for investors. For one thing, share buybacks can be used to manipulate the stock price and earnings per share artificially, especially if they are funded by debt or at the expense of long-term investments. Share buybacks can also create a short-term focus on boosting shareholder value rather than creating sustainable value for all stakeholders. Furthermore, share buybacks can reduce the transparency and accountability of corporate governance, as they can be used to increase the value of stock options and bonuses for executives and insiders. Another group that can be affected by share buybacks is employees. On the positive side, share buybacks can benefit employees who own shares or stock options in the company, as they can enjoy higher returns and lower taxes. Share buybacks can also create a sense of ownership and alignment among employees and management, as they can increase their stake in the company's success. Additionally, share buybacks can enable companies to retain talent and attract new hires by offering competitive compensation packages that include equity incentives. On the negative side, share buybacks can harm employees who do not own shares or stock options in the company, as they can reduce their wages and benefits. Share buybacks can also create a culture of short-termism and inequality among employees, as they can widen the gap between executives and workers. Moreover, share buybacks can undermine employee morale and loyalty, as they can signal that the company does not have any better opportunities to invest in its growth and innovation. The third group that can be impacted by share buybacks is the economy. On the one hand, share buybacks can stimulate economic activity by increasing consumer spending and investment. Share buybacks can also enhance market efficiency by reallocating capital to more productive uses. Share buybacks can also foster innovation and entrepreneurship by allowing shareholders to diversify their portfolios and invest in new ventures. On the other hand, share buybacks can hinder economic growth by reducing corporate investment and innovation. Share buybacks can also exacerbate income inequality and wealth concentration by benefiting mostly wealthy shareholders and executives. Share buybacks can also distort market signals and create financial instability by inflating asset prices and creating bubbles. In conclusion, share buybacks have both advantages and disadvantages for investors, employees, and the economy. While they can increase shareholder value and improve financial performance in some cases, they can also reduce long-term value creation and social welfare in others. Therefore, it is important to evaluate the motives and effects of each share buyback program carefully before making any investment decisions.